Hello to everyone. Welcome to today's class. As you can see from your screens, today's class will be on accounts of partnerships. So we will be looking at how do we prepare accounts of this form of business organization called partnerships. There are a number of areas that we will be covering in the class. Among those will include having an introduction to partnership accounts. So in this case, we will get to know what is a partnership, who are the partners in this form of business organization, and other attributes of a partnership as a form of business organization. Number two, we will be looking at the interest of partners in the partnership. In other words, how are the partners interested, or how is the interest of the partners vested in a partnership kind of business? And in this case, we will be looking at whether a partner has what we call a temporary interest or a permanent interest, or even both. For a partnership to be formed, there has to be terms and conditions that have to be agreed upon by the partners. So we will then be looking at the partnership agreement. And in looking at the partnership agreement, we will then get to know some of those terms and conditions that the partners agree upon before they form the partnership kind of business. After that, we will look at the final accounts of a partnership firm. And in this case, we will be focusing majorly on the two statements that a partnership firm prepares, and that is the statement of incomes and the statement of financial position. And in looking at this, we will try to get the differences between an income statement of a sole proprietorship kind of business against that of a partnership, so that we are able to draw the line or look at the differences between the two. Similarly, we look at the statement of financial position of a partnership vis-a-vis a financial position statement of a sole proprietorship kind of business, so that we are able to see the differences between the two statements. As we will also realize later, is that in cases whereby the profit sharing ratios of the partnership or the partners changes, then assets and liabilities may need to be revalued. So we will look at the revaluation of assets and liabilities of a partnership in case there is what we call a change in the profit sharing ratios. And most importantly, how then do we determine, or how do we treat any gain or loss that may arise in the revaluation of the assets and liabilities? After that, we will look at how can a partnership create goodwill, and how does it treat the same in the books of the partnership. And in this case, we will look at the various types of goodwill and how is each of them created in the partnership, and how it is treated of the partnership. We will also be of a new partner. That is, if the old partners decide to bring in a new partner. So what happens? How do we reorganize the books of accounts of the partnership to accommodate this new partner who has joined in? And of course, what are the requirements of the new partner before joining, and how do we then admit that partner and create him in the books of the partnership? And we will look at the retirement of a partner. So we look at what is the effect of a partner retiring from a partnership? And most importantly, what is that partner entitled to as he leaves or she leaves the partnership? So these are some of the areas that we'll be covering in today's class. So let us start with the first one, and we are looking at the introduction to partnership. And of course, in the introduction, we will first get to know what is a partnership, and of course, how is this form of business carried out. So as you can see, we are saying that a partnership is that relationship that exists between two or more persons who have come together to form a business with a view of making profit. So in other words, we are saying that a partnership is that form of business organization in making profits. So we are saying then that the objective of a partnership firm is to make profits, and that more than one owner, unlike in a sole proprietorship, whereby you find that there is only one owner who provides all the capital and makes all the decisions. In case of a partnership, we have more than one owner who will come together, contribute capital, and therefore start a business, which is called a partnership business. So, having said that, what are some of the reasons as to why a partnership business is formed? Why shouldn't the sole proprietorship business be continued? So there are a number of reasons as to why a partnership firm is formed. Number one being to raise additional capital. You realize that the ability of a single person raising a lot of capital is limited, and therefore there may be need to increase the capital, and therefore bringing in new partners into the business. So the new partners who are brought into the business will then come with what we call additional capital. So for the purposes additional capital, a sole trader may decide to increase the owners to more than one in the business, and thereby forming the partnership. So you realize that the ability of one individual raising enough capital to even expand the business is limited, and therefore you will be having insufficient capital, which will then warrant an additional partner or partners to bring in the deficit capital that may be required. Number two, you'll find that also an individual or a single person may be limited in terms of the skills or expertise that the business may need. So for that purpose, then you may need additional capital, additional partners who will be having different or additional skills and areas of expertise that the business may need. Sometimes you may need an accountant, therefore you may want to add a partner who has accounting skills and etc. And then, of course, the third reason as to why a partnership business is formed is to involve as many persons in the business as possible, especially when it comes to family members. So there are some of the family members who may want to be involved in the business, and so as a result of that, you may need to accommodate family members by making them partners in the new business, therefore forming what we call a partnership business. Let us look at the membership of a partnership form of business. And when we talk about a partnership, we have a minimum of two members. Remember, if you only have one person, then the form of business you are talking about is a sole proprietorship. But if you have to form a partnership, then the membership has to be two on the lower side. That is the minimum of two members, and a maximum of 20 members if we are going to have ordinary members, or a maximum of 50 members if it is going to be a partnership of professionals. So we have a minimum of two members, and a maximum will depend. on the kind of partnership. If that kind of partnership is consisting of professionals, then it should have a maximum of 50, but otherwise it should have a maximum number of 20. So that is the membership, a minimum of 2 and a maximum of either 50 if it is to be a partnership consisting of professionals, or a maximum of 20 if it is a partnership ordinary persons. And then, of course, we have the partnership deed or the partnership agreement. So before these partners, either 2 or 20, or either 2 or 50, depending on the nature of the partnership, there has to be certain agreements between the partners. So those part, and in the agreement they will be stating the various terms and conditions of running the business of partnership. So we are saying then that where 2 or more persons wish to form a partnership, it is recommended that they agree on the terms upon which the partnership will be run and the relationship between each partner. So in essence, we are saying that the partners who come together to form a partnership should come up with the terms and conditions on how the partnership will be run and how do they relate to each other in that partnership. That calls for writing and signing an agreement that bind all the. So that is why we are saying that this will be done in writing and signed as agreed by all the partners, and therefore becomes a partnership deed or agreement. So those terms and conditions of running the partnership and that forms the relationship between the partners will be formed in a document we call the partnership deed or the partnership agreement. So what are some of the terms and conditions that we may find in the partnership agreement? So we have some of them. Number one being the names and addresses of the partners and the partnership. In other words, you expect to have the names of the persons forming the partnership and their addresses. So the address should be both for the partners and for the partnership. So that should you want to engage the partnership or any partner in the partnership, then you know their addresses and therefore you can be able to easily engage them. Number two is the capital to be contributed by each partner. So they have to agree. Do they contribute equal amounts of capital, or they may contribute varying amounts of capital? So should they agree to contribute equal amounts of capital, then it may also follow that they may share the profits and losses equally. However, the profit sharing ratios can be number three, apart from determining the amount of capital to be contributed by each partner, is to come up with the profit sharing ratios. The profit sharing ratios. And in this case, we also mean the profit or even loss sharing ratios. So in a partnership, you share profits, and if it happens that the partnership is making losses, then you also share losses. So it is the profit or loss sharing ratio. So they have to determine what is the ratio of sharing profits. So in the partnership deed, they have to state the profit sharing ratio. Should it be equally or should it be different to the different partners in the partnership? Number four is the salaries to be paid to any partner that is involved in the active management of the partnership. In other words, they may agree that some of the partners may be tasked with a daily task or duty of managing the partnership. And of course, we have just said that you may require some partners with certain skills or expertise. Like you can require a partner with on behalf of the other partners. So if that is the case, then you have to pay salaries to these partners who are engaged in the management of the partnership. So in that case, then you have to agree on the salaries that are going to be paid to the partners who participate in the management of the partnership. Sometimes all the partners may decide to be given roles in management, or some of the partners may be given roles. It will depend on the agreement. The next one, the next content of the partnership is any interest to be charged on drawings. And this is most done in terms of percentage. So if there are some partners who make drawings of certain assets from the partnership for personal use, then you have to charge them interest. So you have to agree on the percentage of interest that is going to be charged on the drawings made by each partner. The next one is the interest to be given to the partner's capital account. Sometimes the partnership may decide that let us pay interest on the capital of each partners, such that at the end of the year, they may decide, let's say 10% should be given to each partner as interest on capital, meaning that the capital they have contributed may actually attract some interest. So in this case, then you have to determine how much interest is to be given to each partner in terms of the percentage, or sometimes they may even decide on a particular amount. And lastly, but not least, is the procedure to be followed when a new partner is being admitted or when a partner retires. So it has to be agreed right from the start what should be the procedure of a partner retiring from the partnership and what is that retiring partner entitled to at the time of retirement. The same way, you have to look at what is the procedure be used to admit a new partner, and that what should the new partner come in with, especially when it comes to goodwill to be paid by the incoming new partner. And those procedures will even go beyond even determining the profit sharing ratios recomputation. In other words, if a partner is retiring, then it means the remaining partner's share of profits will have to increase. So you have to determine what we call the gaining ratio. If you are admitting a partner, you have to recompute the profit shed some of the profit sharing ratios to the new uh, partner. So those are some of the contents of the partnership agreement. And remember, this agreement must be signed at the start of the partnership business, so that as the business is run, then the partners know what is expected of them. Let us then look at the accounting for partnership firms. The accounting for partnership firms. How do we then now do the accounts of a partnership firm? Number one, we want to look at the interest of the partners in the partnership. So we have the interest of the partners in the partnership. That is, what are they entitled to in the partnership? So the interest of the partners can either be long term or short term. So the interest can either be long term or short term. As the long term represent and the short-term interest represent. So the long-term interest is the capital that they have contributed. So the capital contribution of each partner, whatever amount they may have agreed, then that will represent the permanent or the long-term interest of the partner in the partnership. So in that case, then, if it is a long-term interest, it is expected that interest to remain fixed, meaning you are required after you have contributed a certain amount of capital to withdraw some of the capital. So the capital contributed by the partners, which is supposed to be fixed and not withdrawn, then is what we call the fixed interest in the partnership or a long-term interest. That means that this interest can only change if a new partner is admitted, so that now when you admit a new partner, and assuming that you retain the capital of the company, then at that point the capital or the long-term interest may change. Alternatively, it may also change if a partner retires. If one of the partners retires or resigns from the partnership, that may warrant a change in the fixed interest of the partners. So in other words, we are saying that the fixed interest of the partner, which is capital contributed in the partnership, can only change in two instances. Instance number one, when a new partner is being brought into the partnership, so may decide to change the capital to be contributed. Alternatively, number two is when an old partner is retiring. So at that point of retirement, then it means that a new partnership is formed, which will warrant a new capital contribution to be decided upon. So interest number two, apart from the long-term interest, is short-term interest. So the short-term interest is reflected in form of a current account. And of course, we will be able to look at how do we then prepare the current account. So the short-term interest is represented by the current account, and the current account will always be affected by trading activities of the partnership. So as you continue doing business in the partnership, the short-term interest of the partnership will be affected. So in other words, the current account will be affected by the trading of the partnership. And of course, we are talking about aspects like the profits or losses that may be made by the partnership, any drawings that may be made by the partners. So that will be able to change the current account. So the short-term interest is reflected in the current account, and it is as a result of the daily activities that go on in a partnership. Like at the end of the year, the partnership will declare either profit or loss. So in that case, then since the partners are supposed to get a share of the profit, then that will affect the current account. If the partners make drawings, that again will affect their current account. But remember, for the capital account, that is the long-term interest, you expect that the capital that has been decided upon to be contributed will remain fixed unless admission or retirement of a partner happens. So those are the two interests of the partners in the partnership. That is a long-term interest, which is represented by the capital contributed and expected to remain fixed, and the short-term interest, which is reflected by the current account, and it is expected to change as a result of the trading activities of the partnership. Having said that, let us then look at the uh, two accounts that we maintain in terms of the fixed in terms of the long term and the short term interest of the partners. So, depending on what the partnership has decided to do, you will find that most partnerships will maintain both the capital and the current accounts. The capital account will represent the long-term interest, and the current account representing the short-term interest. So, in most partnerships, they maintain the two accounts: the capital account to represent the long-term interest, and the current account to represent the short-term interest. So that means if they are going to maintain both the current and the capital account, therefore the capital account will become what we call a fixed capital account. A fixed capital account. In other words, the capital accounts will not change. So if they are maintaining separate accounts, so a separate account for the long-term interest, which we call a capital account, and another account which represents the short-term interest, which we call the current account. In that case, when they maintain the two accounts, then the capital account, which represents the long-term interest, will be called a fixed capital account. So in this case, you do not expect the fixed capital account to change. We only said it can only change during admission or retirement of a partner. So in this case, you'll find that those two accounts will be maintained. But there are some cases where they do not maintain the two accounts. That is, they don't separate between the long-term interest and the short-term interest. So in cases whereby such is the case, that is no distinction between capital and current accounts, then they maintain one account. So the one account will represent both the long-term interest and the short-term interest. So the account that then will be maintained is called a fluctuating capital account. A fluctuating capital account. It is called fluctuating because the short-term interest is also maintained in the same account. So in this case, they are only maintaining one account, accounting for the short-term interest and the long-term interest. So the kind of capital account that you will have is a fluctuating capital account. So there are some small partnership firms which will deem it fit to just maintain one account as opposed to maintaining the two accounts, each representing its own interest. But when they combine both the short-term and the long-term interest, then the account that results is what we call the fluctuating capital account. And as I said, it will fluctuate because of the fluctuations in the trading activities of the partnership, meaning the share of profits will be maintained or will be recorded in this account. Drawings made will be recorded in this account. Interest earned on capital will also be recorded in this account. So it will keep on fluctuating from one year to the end. But when there is a separation between the fixed, I mean the long-term interest and the short-term interest, the capital account will be fixed. It doesn't fluctuate. However, we are saying it will depend on the size and the policy of the partnership to decide whether they maintain a fixed capital account or a fluctuating capital account. Having said that, then you will find that there are transactions which takes place when you maintain a capital account, when you maintain a current account, or even when you maintain a fluctuating capital account. So let us look at the transactions that will be made when a capital account is maintained. That means you are maintaining a capital account only to represent the long-term interest. So remember, capital has a credit balance. Capital has a credit balance, and that is why you can see from our capital account, we have the opening balances. The, the balances that are brought down are on the credit side. So we have the balances brought down, and these are the balances of the capital contributions. So assuming you have three partners in this partnership, I call them ABC. So you have the capital of partner A, the capital of partner B, and the capital of partner C. So that is the opening balances of the capitals. And these capitals, as we said, are fixed. They don't change unless there is an introduction of a new partner or a retirement of an old partner. So what then can make that capital change, given that it is fixed? That capital can change if, number one, there has been additional capital. So if the partners may decide to add additional capital, then the capital will increase. So you can see additional capital will increase the capital contributions of each member. So it will depend who has brought the additional capital. If it is partner A, then partner A's capital will increase. That is why we are crediting the capital account, because an increase in capital will credit that capital account. If it is partner B bringing additional capital, his capital will increase. Therefore, you credit the capital account of B. And if it is C, then you will credit the capital account of C. So what can make then the capital change is them bringing in additional capital. The second way this capital can increase is by any gain on revaluation. So we talked about assets being revalued in cases of admission or retirement of a new of a partner. So assets will be given new values. They will be valued afresh. So during the revaluation, there may be a gain. So if there is any gain on revaluation of assets and liabilities, then the share of the gain, and the share will be done in their profit sharing ratios, will be credited to the capital accounts of the partners. So depending on the share of A, A's capital will increase. Depending on the share of B, B's capital will increase. And again, depending on the capital of C, the share of C, his capital will change or will increase. And lastly, the capital will increase from a share of goodwill. When you create goodwill, be whichever way or by whichever means goodwill is created, goodwill is normally shared amongst the partners in their profit sharing ratios. The goodwill will be shared to the partners in their profit sharing ratios. And in this case, you'll find that the goodwill share of each partner will increase the capital of that partner. So the share of the share of goodwill of partner A, depending on the profit sharing ratio, will increase the capital of A. The share of goodwill of B will again increase the capital of B, and the share of goodwill of C will again increase the capital of C. So, in essence, we are saying that the capital of a partner in a partnership can increase through the three ways. Way number one, if they bring in additional capital. Way number two, if there is a gain on revaluation of assets. And number three, if there is a creation of goodwill. So having said that, then how can this capital reduce? Because we have said it can increase through additional capital, gain on revaluation, and creation of goodwill. So how can this capital reduce? That is why we are then debiting the capital account. So so a loss is again shared amongst the partners in their profit sharing ratios. So any loss on revaluation of the members or the partners. So depending on the profit sharing ratio, A will have a share of the loss on revaluation, B will have his share, and C also will have his or her share. So that way, you will realize that the share of loss on revaluation will reduce the capital of the partners. And then number two is if the policy if the policy of the organization or of the partnership is to reduce, if the policy of the partnership is to write off goodwill, then you expect at that point that the capital of the partnership will reduce. So those are the two ways in which the capital of the partners will reduce. It will reduce, number one, because of the share of loss on revaluation of assets and liabilities, and number two, because of the share of the goodwill that will be written off. So if the goodwill that has been created is to be written off from the books of the partnership, then that will reduce the capital of the partnership. And the goodwill is the goodwill writing off or amortization is to be shared to the partners in their profit sharing ratios. So those are the transactions in a capital account if the company is maintaining the capital account separate and the current account separate. So what are then the transactions in the current account of the partnership if the partnership has decided to maintain the current account separate from the capital account? So even the current account will reflect the current interest. And remember, current accounts are a form of capital, and therefore you expect them to have a credit balance. That is why you have the balance brought down on the on the credit side. So you may find that for partner A in this our scenario has a credit balance. Partner B, you can see as a debit balance. That is why the balance brought down is on the debit side. And partner C has a credit balance. That is why you have the balance on the credit side. So what will then increase the current balances of the partners and what will reduce the balances on the of the partners? So what are those that will increase the balances of the partners? So we have four items, that will increase the balance of the partners. Number one is the interest on capital. If there is a policy by the partnership that they pay certain interest on capital, then the share of interest of each partner will be credited in the current account. So you expect that in the current account, you have the interest on capital being credited to this. So the interest will depend on the percentage. If it is 10%, so it will be 10% on the capital of contribution of A, the same way 10% of that of B, the same way 10% on that of C. So that will increase their current interest. Number two, the salaries that they receive. those partners who are engaged in the active management of the partnership will have to earn salaries. So any salaries that are earned by the partners. And remember, do not confuse these salaries with the salaries expense. The salaries paid to partners, the salaries paid to partners are paid after or are paid from the profits. They are paid from the profits. So we have salaries of the partners who manage the partnership, and we have salaries of other employees in the partnership. So you have to be careful when you are talking about salaries. You have to demarcate between the salaries of the partners engaged in management of the partnership and the salaries of other staff who are employed by the partnership. So the salaries of other staff are treated as expenses, but the salaries of the partners who are engaged in the running of the partnership have to be paid from the profits. They have to be paid from the profits. So in other words, you will have to appropriate these salaries from the profits. So unlike the salaries of the other staff who you treat as expenses. So if there is any partner earning salaries, it will increase their short-term interest. Number three is the share of profits. If the partnership made profits, then a share of profits will be made here. A share of profits will be credited to these partners. And remember, profits are shared in the profit sharing ratios. And number part of the short-term interest of the partners. So in essence, we are saying that the partners' current account will increase from the interest on capital, from the salaries they receive as partners, from their share of profits, and from the interest that they earn from loans if there is any partner that has loaned the business. Then their short-term interest will reduce on three fronts. It will reduce on three fronts. You can see from our current account, we only have two, but we have three. The first one that will reduce the current interest of the partners is the interest they pay on drawings. So any interest that they pay on drawings will reduce their current interest. Number two, any drawings that they make, the drawings themselves. So the drawings will again reduce their interest. And number three, a share of the loss. If there is a loss if there is a net loss, then the share of that loss will reduce their current interest. So those are the transactions that we normally make in the current account. Remember, the current account, that is part of the capital of the organization, therefore having a credit balance. So having said that, we should then take a very simple uh, uh, illustration to show what we have done. But before we look at the illustration, let us look at the kind of accounts that we prepare for the partnership kind of business. And as I mentioned earlier, that for a partnership business, we prepare basically two accounts. And the first account is a statement of incomes, a statement of incomes. So a statement of incomes, as you know from the sole proprietorship kind of business, is to determine whether a business is making profit or loss. So the statement of incomes for a partnership is the same as that of a sole proprietorship, only that there is a small difference. There's a small difference when it comes to the statement of income of the partnership. So for the partnership, there will be an additional segment the same statement as that of a sole proprietorship, but this one has an additional segment. And that additional segment, we call it the appropriation segment. Appropriation segment. Others will call it the appropriation account. And when we talk about the term appropriation, we are talking about a distribution segment. So there will be a segment where profits are distributed. So in partnership, from the net loss or net profit, we will continue that now that profit or loss that we have made, it will be appropriated. So we have an additional segment we call the appropriation segment or the appropriation account, which will essentially show how are those profits or loss distributed. And therefore, this is how the appropriation segment will look like. So this is the format of the appropriation segment. Remember, we said the income statement of a partnership is we are starting with the net profit for the year. So the the statement of incomes will be the same for both the sole proprietorship and for the partnership up to where we get the profit. But for the partnership, we just continue a little bit with an additional segment. So the additional segment will now then be able to show you how these profits that are made are distributed. So to that profit, to that net profit, we will add, that is now for a partnership. So for a partnership, you will add any interest that the business receives from drawings. So that is why we say add interest on drawings. So each partner, A, B, C, assuming we have our three partners, A, B, C, will pay their interest depending on the ratio or the percentage interest. So for each one, you will compute the interest of each partner and then get the total. So the profit of that year will be increased by the interest received from the partners on their drawings. And that profit will be used to pay the interest on capital. So that is why we will less the interest on capital. So any interest that is paid on capital to the partners will be deducted from that. And that is why you can see the total interest on capital for A, B, and C. You will deduct it from the total profits. So the total profit plus the interest on drawings, then you less the interest on capital. And you then will less any salaries paid. You can see the paid to the partners, those who are engaged in the active management of the partnership. So whatever remains after you have paid interest on capital and paid salaries will then now be shared to the partners in their profit sharing ratio. So at the end of the day, this profit will have with the interest on drawings, which will be reduced by the interest on capital, which will be reduced by the salaries paid to partners. And as I again said, remember, do not confuse the salaries to the partners as other salaries to the other types of staff. And then it will also be reduced or fully consumed by the share of the profits to the partners. So this is the additional segment that we have for the income statement of a partnership. And we can then be able to illustrate that with a very simple illustration. You can illustrate that with a simple illustration. But before we do so, the second statement, remember we said the first statement is the statement of incomes, whereby we have said we have an additional segment, and this is the additional segment. Then number two, we have the statement of financial position, which is essentially the balance sheet, and the balance sheet of a sole proprietorship and that of a partnership are essentially the same. They are the same. The only difference will come on how you present the interest of the partners in the partnership. We said the interest of the partners is in form of a long-term interest presented in a capital account and the short-term interest presented in a current account. So we are saying that this is also the same as that of a sole proprietorship, but the interest of each partner is normally shown separately. It is normally shown separately. And given that if there is any partner who has given a loan to the partnership, then the loan should be shown as a non-current liability. That means the rest of the format is the same as that of a sole proprietorship, except for where you capital and long-term liabilities. So the only difference will become where we have capital and long-term liabilities. So the rest of the format, from presenting the non-current assets, then presenting current assets, then presenting current liabilities, so that you get net assets. So the segment up to net assets is the same as that of a sole proprietorship business. Now the difference will come how you present capital and long-term liabilities. So you can see in this case, capital, in this case, you have to be able to show the capital of each partner, the capital of each partner. So capital of A, B, and C, assuming these are our three capital partners. And remember, where do you get this capital from? This capital should be gotten from the capital account. The capital account. You can see here the capital account and the transactions that we passed in the capital account. So this balance brought down here after effecting all these transactions. This is the balance you will now take to the balance sheet. So these balances here, the balances brought down, these are the ones that you will take to the balance sheet. So in our balance sheet, these capitals here will be from the capital account. They will be from the capital account. And then after you present the capitals, you present the current account again for each of the members, again from each of the members. And where do you get these balances? These balances, you get them from the current account, from the current account. And these are the transactions that you pass in the current account. So these are the transactions you pass in the current account. So these balances brought down here, the balances brought down here, these balances brought down here, these ones are the ones you take to the current and to the balance sheet. So the balances from the current account will be transferred to the balance sheet. So these current accounts that we have in our balance sheet will be from the current account, these ones. So you will get the total capital, which will be comprising the capital and the current account. And then the non-current liabilities, assuming it is B who gave a loan to the partnership, his loan should be presented as a non-current asset. So that is then the difference between a normal balance sheet of a sole proprietor and that of a partnership. Let us look at a very simple illustration to illustrate how do we present our capitals, how do we present the appropriation account, and etc. So our illustration is very simple. We are told A and B own a grocery shop, that their first financial year ended on that 1st December 2019. And at that date, the balances were as follows. The capitals, so we have the partners being A and B. So the capital of A, 60,000, that of B, 48,000. Then these partners are paid salaries for running or taking a role in the running of the partnership. So partner A is entitled to 9,000 salary and partner B 6,000. During that year that ended that 1st December 2019, the drawings of A were 12,860 and the drawings of B were 13,400. For that year, the net profit was 32,840. So the net profit, that is the section up to the net profit, was 32,840, and that the interest on capital is allowed at 10% per year. So 10% interest is to be paid on capital. So you can see the capitals of A is 60,000. So if you get 10%, you get 6,000. The capital of B is 48,000. If you get 10%, the interest is paid on capital is 4,800. So we know that the interest on capital is 6,000 for A and 4,800 for B. And we are told the profits and losses are to be shared equally. So they share profit and losses equally. Then required, from the information above, prepare the firm's appropriation account and the partner's current accounts. So we are supposed to prepare the current accounts and the appropriation account. Remember the current accounts, there are 4 things that we must account for. Know the items that we are supposed to account for. So this is the appropriation account. So this is the current account. You are supposed to credit interest on capital, salaries, share of profits, interest, if any. And you are supposed to debit interest on drawings themselves, and losses, a share of losses. So let us then look at our illustration and how are we supposed to prepare this appropriation account and the partner's current account. So the appropriation account, and you can see here, we have a statement of incomes appropriation account for the year ended at 1st December 2019. We had our profit for the year, our net profit for the year being 32,840. We are supposed to less the interest on capital, which we computed. A was for 6,000, that is 10% of 60,000, and B 4,800, which was 10% of 48,000, totaling to 10,800. So if you less 10,800 from the profits of 32,840, The amount remaining is 22,040. Then here, so this is the appropriation account. So this is the current account. You are supposed to credit interest on capital, salaries, share of profits, interest, if any. And you are supposed to debit interest on drawings themselves, and losses, a share of losses. So let us then look at our illustration and how are we supposed to prepare this appropriation account and the partner's current account. So the appropriation account, and you can see here, we have a statement of incomes appropriation account for the year ended 31st December 2019. We had our profit for the year, our net profit for the year being 32,840. We are supposed to less the interest on capital, which we computed. A was for 6,000, that is 10% of 60,000, and B 4,800, which was 10% of 48,000, totaling to 10,800. So if you less 10,800 from the profits of 32,840, the amount remaining is 22,040. Then here, the salaries for A is 9,000 and 6,000 for B, so totaling to 15,000. So we go back to our solution. Salaries A 9,000, B 6,000, totaling to 15. So when you less 15,000 from 22,040, the balance is 7,040. Remember, we did not have any interest on drawings. So we were not told that we have any interest on drawings. If we had an interest on drawings, then we will add it to our profit of 32,840. But from our illustration, there was no interest paid on the drawings. So in this case, then we don't have that item of interest on drawings. Should we have it, then we add it to our profits. So the remaining profits are to be shared to the partners, and we have been told that the profit sharing ratios is 50-50 equally. Profits and losses are to be shared equally. So in this case, then our profits would be shared equally. So the remaining profits after paying interest on capital and paying salaries is 7,040, which we should pay equally, and therefore each partner should receive 3,520, so that now the total for the two partners should be 7,040. So this is the appropriation segment for that illustration. And of course, the required number 2 is to prepare a current account. We prepare the current account, and you can see from there, the current account, we have it there. So we said the things that we have to debit our current account with. In this our illustration, we did not have any balances in the current account. So we were not given the opening balances for the current account. So if we had the opening balances, then we will credit those opening balances in the current account, in our current account here. And if there was any partner with a debit balance, we will debit the same in the current account. But we have the interest on capital, which is 6,000 for A and 4,800 for B. The salaries, 9,000 for A, 6,000 for B, and the share of profit, which we have computed in our uh, account here, in our appropriation account, to be 3520. So each partner will get 3520. And then, of course, we were given the drawings. So the drawings for A were 12,860 and that of B 13,400. So when you do the balancing off of this account, you will get that the balances brought down for A is 5,660 and 9,020 for B. So that is how our current account will look like. Having said that, we can also look at another illustration which has more information. You are told, as our illustration number 2, draw up a profit and loss appropriation account for the year ended 31st December 2019 and a balance sheet extract at that date. So in this case, now we want to see how will we prepare the balance sheet, especially that part where the capitals are required to be prepared. So we have the net profits for the year being 30,350. In this case, we have been given, number 2, the interest to be charged on capitals. So our partners is W, P, and H. So interest to be charged on capital for W, 2,000, for P, 1,500, and for H, 900. Then we have the interest to be charged on drawings. So interest to be paid on capitals and interest to be charged on drawings for W 240, for P 180, and for H 130. Then we have been told that some of the partners are engaged in the running of the partnership and therefore they are paid salaries. So salaries to be credited. So P 2,000 and H 3,500. So those are the salaries that are to be paid to be paid to the partners. So you can see it's only partner P and H who are engaged in the running. So W is not paid any salary. Then profits to be shared. W to get 50%, P 30%, and H 20%. So the profit sharing ratio is 5 to 3 to 2. Then the balances in the current account, W 1860, P 946, and H 717. Then the capital accounts, the balances that are brought forward, 40,000 for P, 30,000 for, 40,000 for W, 30,000 for P, and 18,000 for H. Then the drawings for W, 9,200, P, 7,100, and H, 6,900. So that is the information we are given. So we are supposed to prepare, number 1, an appropriation account, and number 2, a balance sheet. So we must prepare the two, but again, for us to be able to prepare the balance sheet, we have to prepare the capital account and the current accounts. So let us then look at the appropriation account. We are given the profit for the year under number 1 here of 3350. You can see we have it here, 3350. Then we add an interest on drawings, and we have been given the interest on drawings. Here we have been told the interest to be charged on drawings under number 3, 240, 180, and 130 for WP and H respectively. You can see 240, 180, and 130 to give you a total of 550. So when you get 550 from 30, when you add 550 to 3350, you will get 3,900. And then from there, you are supposed to deduct the interest charged on capital. And you can see from our illustration here, the interest to be charged on capitals under number 2 is 2,000 for P, for W, 1,500 for P, and 900 for W. So when we total the three, 2,000, 1,500, and 900, we get 4,400. This one we are deducting. So we will get a difference of 26,500. So when you less 4,400 from 3,900, you will get 26,500. Then you are supposed to less the salaries, and the salaries we have been given for only two partners, P and H. You can see the salaries under number 4. The salaries to be credited for P is 2,000 and 3,500 for H. So when we total the two, that's 2,000 plus 3,500, we get 5,500. So when we less this from the 26,500, we get 21,000. So the profits that remain after adding interest on drawings, deducting interest on capital, and the 21,000 has to be shared between the partners, and the profit sharing ratio we have been told, that is the profit sharing ratio here, is 50% for P, for W, 30% for P, and 20% for H. So if we compute the 50% for W, that is 50% of 21,000, we get 10,500. 30% of 21,000 is 6,300, and when you total this, you should get 21,000. So that is then the appropriation segment for this illustration. And of course, for us to prepare the balance sheet, we have to prepare the current account. We have to prepare the current account. So the current account, remember the items that are supposed to be accounted for or recorded. Remember, we start with the balances, and in this case, we were given the balances that are brought forward. You can see from our illustration, the current account, the balances is 1860W, 946P, and 717H. So you can see from our current account, we have brought those balances here, 1860P, 1860W, 946P, and 717H. And we said any interest that is received on capital for each member, we have to bring it here. And we were given the interest on capital. You can see the interest on capital on our illustration. Interest on capital, 2000W, 1500P, and 900H. So we bring them into their respective partners. So you can see 2,000 for W, 1,500 for P, and 900 for H. Then the salaries, we were told it's only two partners who receive the salaries, P and H. 2,000 and H receives 3,400, and we computed the share of profits. So from our appropriation account, we computed the share of profits, 10,500 for W, 6,300 for P, and 4,200 for H. So we bring them here. This should be 10,500. Here it should be 10,500, and then 6,300 for P, and 4,200 for H. So there is a small error here. It should be 10,500. Then you now debit this account with interest on drawings we were given. You can see the interest on drawings. The interest on drawings, which is presented by our number 2 of the illustration. Interest on number 3 of the illustration. Interest on drawings 240, 18, and 130 for W, P, and H respectively. We have been able to present it in our account 240, 18, and 130. And then the drawings from our illustration have been presented under number 8, 9,200, 7,100, and 6,900 for W, P, and H respectively. So if you bring them here, you have 9,200, 7,100, and 6,900 for W, P, and H respectively. When you balance off this account, you will get a balance brought down, which we should be down here for all the partners, 49, 20, 36, 34, 66, and 22, 87 for W, P, and H respectively. These are the ones that we will now transfer to the balance sheet. So our requirement then to prepare a balance sheet, we will prepare that extract. So the net assets will be a certain amount. So the capital, these ones did not change. Remember, we said this capital is normally fixed unless there is admission or retirement of a partner, or unless there is goodwill. None of those three are present. So the capitals remain the same. W 40,000, P 30,000, and H 18,000, totaling to 88,000. And the current accounts as computed, you can see from our current account as computed here, 49, 20, 36, 34, 66, and 22, 87. These are the ones that we will bring to our balance sheet here. So these three totaling to 10,673. So when you add 88,000 to 10,673, you will get 98,673. So that is how then you are supposed to prepare uh, the balance sheet extract from the illustration that we are given. In our face-to-face class, we will look at now a comprehensive illustration, the ones that you are supposed to start from there, but the income statement and thereafter the balance sheet. So we will look at a comprehensive uh, illustration where we start from the income statement itself up to the appropriation segment, and then the entire uh, balance sheet, not just an extract as it is in this case. Let us then look at other items of the partnership account. And number one, we look at goodwill and revaluation of assets and liabilities. Goodwill and revaluation of assets and liabilities. Now, we start with goodwill. So we will get to know what goodwill is and the various types of goodwill, but more important, how can we treat goodwill in the books of accounts? So let us look at goodwill. So in a case between Hal and Phrases, the judge in that case made a conclusion and defined what goodwill is. And they defined that goodwill is the advantage, whatever it may be. So whatever advantage that a person gets by continuing to be entitled to represent to the outside world what he is carrying on in a business which has been carried on for some time previously. If you look at that definition of goodwill by Judge Warey, it is that for this goodwill to be present is that number one, the business must have operated for some time, that the business must have been carried out for some time. So it essentially means that you cannot have goodwill for a business that has just started or or is just new. So the business must have operated for some time. And number two is that goodwill is that advantage, meaning the advantage that you have that others don't have by virtue of them not being in a business setup that has operated for some time. So it means, therefore, that for you to have goodwill, the entity for which you are talking about should have operated for some time. And because it has operated for some time, it has been able to survive in the harsh business environment when others did not survive. So it means that if you are a part of the owner of that business, then there is a certain advantage that you have by virtue of that business having operated for some time. In essence, what we are saying that goodwill is the element that arises from a business due to its reputation, due to its image. So if your business has a good image, has a good reputation, then there are certain advantages that that business will enjoy up and above those other businesses that are essentially new. And we are saying, for instance, that a new business may not make profits easily during the first years of trading. But if a business has been operating, it will make profits. And because it will make profits, then you enjoy that benefit. You enjoy the profits from that business. A new business will take time before it even breaks even. The first years, it will make losses. And therefore, that is what goodwill will amount to. So, goodwill is any advantage that is enjoyed by virtue of a business having operated for some time, and that benefit may not be available for those businesses that have just been, you know, or formed. Then, what are some of the factors that affect goodwill, or what are some of the things that you can look at and conclude that your business has goodwill? Number one is the quality of the products or services. That sometimes, because the organization will be producing good quality products or offering good quality services, then it will qualify to create goodwill. Number two is good personnel. So if you have dedicated, experienced, and qualified personnel, then you can create goodwill for that business. Number two, it is marketing, that the business has a good name in terms of marketing. In other words, it is easy for them to market their products. In other words, it must have established the distribution outlets so that it is easy for it to market its own products. The other one is that the business could be located in a good place whereby it is easily accessible to many of its customers. Like if you're talking about a supermarket that is located around a stage, then it is easy for that supermarket to be accessed by many people. So the location of the business is very important in terms of the determination of good. Lastly, the period of operation, that the business may have operated for quite some time, and during that time that it has been operating, it must have made profits and it has existed for long, which means it may not have closed a shop when other businesses, because of the harsh economic or business environment. And we are saying, therefore, that goodwill is very important. It is very important in determining the partner's share. In other words, the partners may have put effort and resources in creating that goodwill. So, in accounting, is attaining the element or the share of the partner's effort to improve the business. But a challenge that comes is, how do you then determine the value or the cost of this goodwill? How do you determine the cost of the goodwill? And that is where now we should be able to look at the various types of goodwill. So the various types of goodwill will be able to tell us how can we estimate the cost or the value of this goodwill. And we have two types of goodwill. We have what we call the non-purchased goodwill and the purchased goodwill. So we have the non-purchased goodwill and the purchased goodwill. When we talk about the non-purchased goodwill, is that goodwill which we estimate by, and we are very careful in using these terms, subjective means, or it is determined by subjective estimates. In other words, we don't have a good basis for determining the value of goodwill because it was not purchased. For instance, we can arrive at goodwill by taking the average profits for let's say 3 years. So if you say that the profit of the previous 3 years was 50 million, 32 million, and 72 million, we total them and we average. So the average should give us the goodwill that we will create in our books. But that way, it is not what we call objective because it is subjective. Remember, the business environment keeps on changing, and if you take an average, you are assuming that every year you will have a certain value of goodwill, which is not true because every year has its own unique challenges, and therefore the factors that affect a business this year may not necessarily be the same that affect the same business the next year. So, due to its subjective nature of the determination of goodwill, then we do not maintain the non-purchased goodwill in our books. So, the non-purchased goodwill is not maintained in the books of accounts. So, what does that mean? That means it's only the purchased goodwill that we will maintain in our books. Now, the second type of goodwill is the purchased goodwill. And the purchased goodwill is simply the excess amount that we receive or we pay up and above the net assets that are acquired. In other words, when we are purchasing, for instance, a business, we normally pay for the assets of that business. So if it happens that you pay more than the value of the assets of the business, then the difference will become the goodwill. And a very simple example that we may pay for a business, for acquisition of a business, 3.5 million. And uh, when you look at the value of the assets we are paying for is 3 million. So we are paying 3.5 million to acquire assets of 3 million. It means therefore that the difference between the purchase price, that is 3.5 million, and the value of the assets purchased, that is 3 million, the 500,000 is the goodwill. So goodwill will be treated as 500,000. And goodwill normally in our books of accounts, we present it as an intangible asset, a long-term intangible asset. So that is purchased goodwill, and it is the one that we normally maintain in our books of accounts. So then, how do we treat this purchased goodwill in our books of accounts? So in our books of accounts, there are three main ways in which we can treat goodwill. So we have three main ways in which this goodwill can be treated. Number one, goodwill will be written off from the books of accounts. So immediately we determine the goodwill, we write it off. So it is immediately written off, immediately it is determined. So we determine, for instance, it is 500,000, and immediately we write it off from our books. And of course, how do we write it off from our books? We share it amongst the partners, and therefore it ceases to exist in our books of accounts. So that is one way. Another way, number two, is to carry it in the books of accounts and amortize it over a period of time. In other words, we can have it in our books of accounts, but we write it off slowly, gradually. So pole pole, we will write it off over a period of time. We can say, for instance, we have determined our goodwill is the 500,000, but we say this goodwill should be written off within 5 years. So maybe we can say then every year we shed off 100,000, so that by the time 5 years elapse, we will have completely written it off from our books. So we can carry it in the books of accounts and slowly write it off over a period of time. And the period will be determined by the organization or by whichever method that the organization may deem fit. So, depending on what period they come up with, goodwill will be written off within that period. Or number three, we can carry it without amortizing. In other words, we can continue having the goodwill in our books as long as we can. So there are three ways. We create goodwill and we write it off immediately. Or number two, we create goodwill and we retain it, but we write it off slowly until it is written off fully. Or number three, we carry it always in our books. What is the practice that normally happens? So the practice is normally to carry it in the accounts together with other assets and as an intangible asset and amortize it over a period of time. So the best way that goodwill will be treated is the second way. You carry it in your books and write it off gradually over a period of time. So the second way is the most important way of uh, dealing with this goodwill. So having said that, let us see how we can treat this goodwill. So in a partnership, there are normally three situations. There are three situations where goodwill will be accounted for. Remember, we have said that this goodwill, the practice is that we maintain it in our books and we write it off gradually over a period of time. So, what are some of the situations when we create goodwill? So, we know if goodwill is created, and we are talking about the purchased goodwill. So, the purchased goodwill is created, and we have said the practice is to keep it in our books and write it off gradually. So then, when does this goodwill arise? When does it arise? And if it arises in any of those ways, how do we deal with it? So there are three ways in which this goodwill will arise. So there are three situations when goodwill is created in our books of accounts. The first situation is when there is a change in the profit sharing ratio. So when the partnership decides to change the profit sharing ratio, then goodwill will be created. Number two is when a new partner is admitted. So when you admit a new partner, you create goodwill. And number three, when an old partner retires. So when an old partner retires, goodwill is created. So we want to see how do we treat goodwill when there is a change in the profit sharing ratio, when there is an admission of a new partner, and when there is a retirement of an old partner. Number one is when there is a change in the profit sharing ratio. So when the partners decide to change the profit sharing ratio, they will create goodwill, meaning goodwill will be introduced in the books of accounts by opening the goodwill account. And remember, we said goodwill is an asset and an intangible asset. So it is a non-current asset and intangible non-current asset. So how do you then now create it in your books, or how do you introduce it in your books? You pass an entry. You pass an entry by debiting the goodwill account. So you determine the goodwill, let's say 500,000, and therefore you will debit the goodwill account with 500,000, and that goodwill will be shared amongst the partners in the old profit sharing ratio. So you will credit the partner's capital accounts, the partners' capital accounts with the share of goodwill using their old profit sharing ratio. Remember, this is when a profit sharing ratio has done what? Has changed. So to introduce it in your books, you debit the goodwill account and credit the partners' capital accounts, and the partners will share the goodwill in their old profit sharing ratio. Now, when goodwill is to be written off, because we said we maintain goodwill in our books and write it off slowly or gradually until it is fully written off. So every time you write it off, this is the transactions that you will be passing. So we are saying that if the goodwill is to be written off from the accounts, then this will be done by you debit the capital accounts of the partners with the new profit sharing ratio, because remember the trigger of the change of the creation of goodwill is the change in PSR, the profit sharing ratio. So when you are introducing the goodwill, you use the old profit sharing ratio. When you are writing it off, then you use the new changed profit sharing ratio. That is why for the part that is to be written off, you will debit the partner's capital account with the new profit sharing ratio and credit the uh, uh, goodwill account with, of course, with the amount that has been written off. Then we have a simple illustration to show how we treat goodwill in the books of accounts. So that number, we are told that A and B have been trading as partners, sharing profits and losses equally. So we have been told that the profit sharing ratio is 50-50, 1-to-1. So they decide to change the profit sharing ratio to 3-to-2. So in that case, they have triggered a change in the profit sharing ratio. And remember, as a result of that, if the profit sharing ratio changes, then you have to introduce goodwill. And we are told that the capitals for the partners are A, 1 million, and B, 1.5 million. So we have the capital accounts of the partners being 1 million and 1.5 million for A and B, respectively, and that goodwill has been agreed. So as a result of the change in profit sharing ratio, they agree to introduce goodwill at 500,000. So goodwill has been introduced at 500,000. So what is required? Required, number A, the partner's capital accounts if goodwill is to be retained in the accounts, and number B, the partner's capital accounts if goodwill is to be written off. So we said, when we introduce goodwill, what are we supposed to do? When we introduce goodwill, the transaction that we pass is to debit the goodwill account. And in this case, we have been told that the goodwill is 500,000. So we are supposed to we create the goodwill account by debiting the goodwill account with 500,000, and we credit the partner's account. We create the partner's capital account with the goodwill, but shared in accordance to the old profit sharing ratio. And we have been told the old profit sharing ratio, uh, the old profit sharing ratio is 50-50. So the old profit sharing ratio is equally, so 50-50. So our solution for A should be this. Our solution for A, the capital accounts, of course, we have the balances brought down, 1 million for A and 1.5 million for B. You can see from our illustration here, A 1 million and B 1.5 million. And then now we are supposed to uh, share this goodwill according to the old profit sharing ratio, 50-50, because the transaction that we are supposed to pass is to credit the partner's capital account with the share of goodwill in accordance to the old profit sharing ratio, and the old profit sharing ratio is 50-50, and therefore if you get 50% of 500,000 is 250,000. So the partners, you can see here, we will credit the partner's capital account with 250 for each, so totaling to 12 and 1750,000. So 1.25 million for A and 1.75 million for B. So that is our solution to A. So that is when we are assuming that the balance for the capital is 1.25 for A and 1.75 for B. That is when goodwill is retained in the books of accounts. Number B, if the goodwill is to be written off from the accounts. And we have said here that if the goodwill is to be written off from the accounts, we will use the new profit sharing ratio. We will use the new profit sharing ratio by debiting the partner's capital account and crediting the goodwill account. So if we are going to write it off, we will use the new profit sharing ratio, and the new profit sharing ratio is 3:2. The new profit sharing ratio is 3:2. So that means if we were to write it off, so we will start with the balances. So the balances are 1 million for A and 1.5 million for B. When the goodwill was created, so when we create the goodwill, we use the old profit sharing ratio, OPSR, old profit sharing ratio, 250 and 250 to give you this total. But when we have to write it off, we use the new ratio. So the new ratio is 3:2. So 3 over 5 of 500,000, you get the share of A is 300,000 and that of B is 200,000. So when you balance off the account, you will get that the new balances for A is 950,000 and for B is 1.55 million for B. So those are the new balances if the goodwill is to be written off. Remember, if we have to write off the goodwill, we use the new profit sharing ratio. But when we are introducing the goodwill, we use the old profit sharing ratio. So that is the solution to that. So that was number one, dealing with goodwill. Let us go to number two, where we are talking about revaluation of assets and liabilities. Revaluation of assets and liabilities. So when it comes to revaluation of assets and liabilities, this is normally done uh, when a new partner is admitted or when an old partner retires. So value some of its assets to reflect their fair values. And we are saying then that when a new partner is being admitted, a new partnership is essentially formed. So if a new partnership is essentially formed, then you need to uh, 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 revalue some of the assets. So you have to start afresh. So even the values of the assets and liabilities have to be new. So the partnership then may decide that some of the assets or all the assets and liabilities be revalued afresh or be given a new value. So, and we are saying in most cases, the revaluation is done when admitting a new partner or when retiring an old partner. So, in the process of revaluing the assets, there may be a gain in the new values or there may be a loss in the new values. So, there may be a gain or loss on revaluation. So that means for you to determine the gain or loss on revaluation, you create a new account, which we call a revaluation account. So the revaluation account is to be used to determine any gain on revaluing the assets and liabilities, or any loss in valuing the assets and liabilities. So it means, therefore, that the balance which will be in this account will either be a profit on revaluation or a loss on revaluation. So any gain or loss on revaluation is to be transferred to the partner's capital account. So a loss or a gain is to be transferred to the capital accounts of the partners. That means if there is a loss or if there is a gain on the revaluation of assets and liabilities, meaning if there is a profit on the revaluation of assets and liabilities, then the profit is to be shared by the partners in their profit sharing ratio. So in that case, then you will pass the entry of debiting the revaluation account and crediting the capital accounts of partners using the profit sharing ratios. So they will the capital of the partners will increase by virtue of the profit on revaluation. If it is a loss, then you will debit the partner's capital account, of course, using the profit sharing ratio, and the revaluation account is credited. So this PS should be on the partner's capital account. So you will debit the partner's capital account. In other words, the loss will be shared by the partners in the profit sharing ratio, and the revaluation account is credited. So that is the entry that is passed if there is a loss on revaluation. So to illustrate that, let us look at an illustration for our revaluation of assets and liabilities. That A, B, and C are trading as partners, sharing profits and losses in the ratio of 2 to 2 to 1. So the profit sharing ratio is 2 to 2 to 1 for A, B, C, for A, B, and C respectively. And you are told that they have the following assets and liabilities at the book values, and they wish to revalue, or in that case, restate these values at the market value as and agreed values as follows. So we have the asset, the book value, the market value or the agreed value, then the gain or loss. So we have the buildings with a book value of 2 million, but a market value of 2.5 million, meaning a gain of 500,000. The furniture, fittings and fixtures, a book value of 900,000, a market value of 800,000 with a loss of 100,000. Motor vehicles, a book value of 1.2 million, a market value of 1.15 million, and a loss of 50,000. The inventories, book value of 700,000, a market value of 650,000, a loss of 50,000. The debtors, a book value of 450,000, a market value of 400,000, and therefore a loss of 50,000. Then we have the creditors, a book value of 800,000, the market value of 700,000, and meaning the difference is again because the creditors you are supposed to pay 800,000, but you can pay 700,000 in the market, so there has been a gain of 100,000. Required, prepare the revaluation account and the partner's capital account given the balances, given the partner's balances as A, 3 million capital, 2.5 million, and 1.5 million for C. So these are the capital accounts of the partner. So we are required to prepare the revaluation account. And we said for the revaluation account, we will credit any gain. So So any gain is credited and any loss is debited. So we debit a loss in the revaluation account and we credit a gain. So we know those assets that have a gain. So in this case, we have two assets. We have one asset that is buildings and a liability creditors that have gains. So total gain is that of 500,000 and 100,000 totaling to 600,000. So we should credit this revaluation account with the 500 and 600 and therefore debit this account with the losses, that of furniture 100,000, that of motor vehicle 50,000, that of the stocks 50,000, and that of the debtors 50,000. So this is how our revaluation account will look like. We credit the account with gains, and you can see billing 500,000 and creditors 100,000, totaling to 600,000. So if we bring the losses, the first one was for fixtures 100,000. You can see from our illustration here 100,000. Motor vehicles 50,000. Stocks and debtors 50,000 each. So if you look at the revaluation account, motor vehicles 50,000, stocks 50,000, and debtors 50,000. So the total of this is 250,000. So when you less this from the 600,000, you will get 350,000. So our profit sharing ratio is 2 to 2 to 1. So if we were to get there, so you can see the gains are more than the losses. So the net effect is that a gain of 350,000. So that gain of 350,000 is shared to the partners in their profit sharing ratio. So A will get 2 over 5, which is 140, the same as B, which is 140, and then C, 70. So that gives you 350. So that is the revaluation account then. And we should then be able to prepare the capital account where we will, of course, we have the opening balances of 3 million for A, 2.5 for B, and 1.5 for C. You can look at our illustration. The capital accounts is 3 million for A, 2.5 million for B, and 1.5 million for C. So those are the opening balances. You can see we have the balances brought down. And then we have the revaluation, the share. Uh, uh, every partner shared. Every partner got a share according to the profit sharing ratio: 140 for A, 140 for B, and 70 for C. You can see from our revaluation account, 140 for A, that is 2 over 5 of 350. You get 140, 140 for B, and then 70 for C. So they get each share. So the total will be that 140 for A, 2640 for B, and 1570 for C. So those are the new balances for the part having shared the revaluation gain. So that is how you are supposed to deal with that uh, 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 revaluation of assets when you create a revaluation account. If it was a loss, then you know the entries that you are supposed to pass. For a loss, you have to uh, credit the revaluation account and debit the partner's capital account. But since this is a gain, we debited the revaluation account and credited the capital account. So let us see what happens when you admit a new partner. When you admit an So essentially, when a new partner is admitted into the partnership, then the old partnership comes to an end and a new one starts. That is why you need to revalue the assets and liabilities. As you can see now, if that was the case in our illustration here, it means our new capitals will have been 3140, 2640, and 1570 for A, B, and C respectively. and the new assets values will have been 2.5 million for buildings, 800,000 for furniture, 1.15 million for motor vehicles, 650,000 for stocks, 400,000 for debtors, and 700,000 for creditors. So it essentially means that when a new partner is admitted, then the old partnership comes to an end and a new one is admitted. That is why you see we have the new values of assets and we have the new values of capital. So the new values of capital is as per our capital account, and the new assets values will be as the market price depicts. Then the new partner is supposed to bring in capital and pay goodwill that will have been determined. So the goodwill that is created, the goodwill that the new brings will be credited to the old partners in their old profit sharing ratio. So the old partners will get a share of the goodwill that is brought or that is paid by the new partner in their old profit sharing ratio. Now, you want to write the goodwill off. Remember, when you create the goodwill, the beneficiaries are only the old partners. Remember, the amount that is paid by the new partner as goodwill is shared amongst the old partners in their old profit sharing ratio. But if that goodwill is to be written off the books of accounts, then it will be written off to all the partners. So if goodwill is to be written off, the one that the joining partner has brought, if it is to be written off, then it means they will all get a share, including the new partner. And the profit sharing ratio they will use is the new profit sharing ratio. So the new will bring in capital, and that capital, will bring in goodwill, and that goodwill will be shared by the old partners in their old profit sharing ratio. And should the organization decide to write it off, then it has to include the new partner and use the new profit sharing ratio. And then we have to note that if the admission of the new partner is taking place way through the financial period, that is in the middle of the financial year, then we have to know that the joining partner should be entitled to a percentage of the profits, that is from the time he joined, and of course, any losses should also be equally apportioned to the time is joined. So we have to pay attention to the point of joining of the new partner. So normally, partners are supposed to join either at the start of the new year or at the end of the financial year. But should it happen that they join through midway through the financial year, then they have to be entitled to a share of profits or losses from the point at which they joined. So we should then be able to know how do we even apportion the interest of the capital and the salaries that are paid to these partners because of the changes. So that way we must be careful in looking at the point of joining of the new partner. That also applies even when the partner is exiting. Even when the partner is exiting, if he exits at the middle of the financial year, then what is entitled to must be computed at that point of exiting. So when a partner retires, so retirement of a partner. So when a partner retires, that again, similarly, like when a partner is joining, that will mean that the old partnership comes to an end and a new one starts. So when a partner retires, this marks the end of the old partnership and the start of a new one. And the partner who is leaving is supposed to be paid all that is due to him or her. And that will include his capital balance, as it will be determined by the capital account, his share of the goodwill, his credit balance on the current account, meaning if he has a debit balance on the current account, he's supposed to pay. So he will pay the balance that may exist in the current account, if any. He should also be entitled